tariffs don't necessarily have to be this end all of economic growth. I think the consumer, when you look at the consumer, they have been really very resilient. Our view has been that the market is going to broaden out, but if that has to come along with and in parallel with earnings growth, right? If you look at part-time work versus full-time work, obviously full-time workers are going to be the vast majority of our workforce, but part-time growth has grown significantly over the last couple years. There's all of these things that go into the historical assumptions around the labor market that I think are a lot different now. Most people fail into investing, so they don't read the book and they don't learn to do it the right way. I believe that we spend far too much time as historians and not nearly enough time as futurists, as investors.
You're watching Excess Returns. We're talking macro. We're talking volatility. We're talking, because there's just so much going on here in the world that there's nothing not to talk about. Why does each hour of March 2025 feel like it's aging me 6 years at a clip? I don't even know if I'm going to survive to the end of this podcast. Actually, I do. These people are going to keep me going. Matt Zeigler joined today. Two brilliant guests. Lindsey Bell, Chief Market Strategist of Clearnomics. Lindsey, welcome to Excess Returns.
Thank you for having me.
Our pleasure. And Shannon Saccocia, Chief Investment Officer of Wealth at Neuberger Berman. Welcome to the show, Shannon.
I'm so excited to be here.
So holy intraday price swings and everything else, it's literally has just been madness out there. That's how I'm feeling. How's an individual supposed to be long-term anymore when everything's so short-term? I want to jump straight into the deep end. Talk tariffs to me. Lindsey, you go first. Like, what's going on? Tariffs, are they terrifying? Are they terrible? Are they terrific? Where do you come down on this?
I mean, I think the uncertainty and the back and forth about tariffs is terrifying because nobody knows where we're going, right? Every day, every hour, it almost feels like there's a new announcement of what is happening with tariffs. And I think investors are at the point where they're just kind of throwing their hands in the air and giving up. And, the question is when is the market going to find the bottom? And I do think that that for the market to stabilize, to even turn around, what we really need is a change in narrative, a change in rhetoric on tariffs, or at least more clarity and certainty. Businesses can handle tariffs. We handled tariffs in 2017, 2018. We have a long history of tariffs in this country, actually. But the fact that we don't know what they're going to be, how long they're going to last, it makes it very difficult for businesses to operate on a daily basis, which then makes it very difficult for investors to understand what are earnings for these businesses going to be in the near term. So I think it's just like we're in this place of uncertainty, and it's, a lot of us are wait and see, but a lot of us don't have the fortune to be in wait and see, right?
What do you think about that, Shannon? The fortune to be in wait and see. That's a very real feeling right there.
Right. And it's not just investors, right? It's U.S. businesses. So, I mean, if you look at the enthusiasm, the optimism about this constructive business environment that we were entering into in 2025, deregulation, easier permitting, animal spirits. I mean, there were so many things that were driving that. And yet when you looked at, and you actually see that, you see it in CEO confidence, you see it in small business confidence, the NFIB. But interestingly, weighing that confidence, even in the same survey, is this increase in uncertainty. And I think that the challenging thing about tariffs is that if it really is this short-term negotiation for concessions type environment where we anticipate there's going to be exemptions, or perhaps we are looking ahead to say, okay, these aren't going to be protracted or sustained. Well, that's sort of a point in time disruption, right? And you get companies coming out and giving uncertain outlooks or just saying we're going to be conservative. I think the real question, if you think about economic growth and, this theory of American exceptionalism, if you will, is this a true shift in how we look at trade policy? Like, are we really trying to become more insular and isolated and utilize tariffs as a revenue generating tool? Well, that's a whole different dynamic, right? And I think that's where, if you see folks that are very becoming rather bearish on economic growth and expectations around that, I think that's where you're seeing the challenge. And so we're not in that camp here at Neuberger, but I do think that there's this other side of the coin that I think is weighing on businesses to say, you know what? Maybe we just have to wait and see, to Lindsey's point, how this is going to play out. And maybe we don't want to commit to this additional capital expenditure, this hiring. It's probably not, it's probably worth it just to kick the can down the road for 3 or 4 more months and see how this plays out.
So confidence in that frame, Shannon, just pull this out a little bit for confidence is the ability to basically see beyond the short term. And if I'm a CEO or an executive or a business planning the things that make earnings, when that confidence goes down, like, do you think our businesses starting to seize up in their decision making? Are we actually seeing that yet?
Well, I think we were actually seeing them start to talk about making growth-oriented decisions and, as they came into the election. But no one's really put pen to paper yet, right? So I think that's what you're seeing is like, hey, we said we were ready when we'd see this kind of policy tailwind. We'd be ready to invest and ready to hire more and ready to be more pro-growth. But doesn't seem like you're kind of delivering that environment for us right now. So we'll just go back to the way we were before, which is kind of being conservative and focusing on margin and focusing on our core businesses. And we'll see how this unfolds before we really start to put pen to paper and put our money where our mouth is.
What
I
I
love
would just like add to that, where you are seeing it, to Shannon's point, is companies' plans for hiring started to tick up going into the election and into the end of the year, and now they're starting to tick down. So it's exactly what Shannon said. And the other place I feel like you're seeing it manifest is in the PPI. Prices have gone up there, and there's speculation. It's hard to say for certain. You look at some of the ISM surveys, and you hear all that everybody's talking about is tariffs in those surveys, right? So there is this speculation that the producers are starting to raise prices to get ahead of the potential tariffs. So, and then there's companies like Walmart that's, there's headlines coming out now. They're already having conversations with suppliers in China to reduce their prices for them to absorb the price increases rather than Walmart taking a hit to margins or having to pass it on to the consumer. And those are, if these tariffs go through, those are the decisions that are going to need to be made. Who's going to take on the pricing? And I think that's the other important point about this time around. I said we dealt with tariffs in 2018, 2017, 2018. This time is a little bit different, though, because the consumer is much more price sensitive than they were then because of all the inflation that we've endured up until this point in time. You see it in the University of Michigan survey with plans to purchase durable goods and big purchases. That has plummeted. So you see it there. But on the flip side of that, organizations also have changed their sourcing. And so there's been a lot of movement around over that period of time. And so it's just a little bit of uncertainty about how it all shakes out and who's going to pay the bill at the end of the day, right?
what you're saying, basically what Shannon just said too, about it's that focus on margin. It's basically like, what can I actually control? What can I protect in either hiring or layoffs or whatever it is? So what we're watching in real time is these micro adjustments to saying, how do I just protect the core business?
Correct. And I think what's interesting about this whole debate too, like we don't know where tariffs go. If they end up being significantly reduced because we're using it as a negotiating tactic for something else, then there's going to be less of a margin worry. But when I look at 2025 operating margins, and I use Capital IQ numbers, I'm looking at about 17% operating margin for 2025, which would be an all-time high, and that's higher than what we saw at the peak inflation in 2022. We were only just over 16%. So the question does become, there is the ability probably for corporations to absorb some of these higher costs, but what's the wherewithal? You have to think about the shareholder too at that point in time. And so we shall see how it plays out. But that's been something I've been keeping an eye on, is the margin story.
It's really interesting. Shannon, are you paying attention? Do you focus much on this, just operating margins?
Well, I think it's important to us in terms of our thesis about earnings growth driving more
Right.
of the market performance this year, right? Rather than multiple expansion. And our view has been that the market is going to broaden out. But, if that has to come along with and in parallel with earnings growth, right? Because we're not anticipating that all of these kind of broader companies down cap across, small, mid cap, and then the large caps that haven't participated to the same extent over the last 2 years. We're not anticipating that all of their multiples are just going to expand due to enthusiasm around a new thematic, right? So we're really looking for earnings to be delivered, and margins are a big part of that. I mean, we can talk about whether we think, GDP growth is going to be 2% or 2.5%, but it's probably not going to be -3% or whatever the Atlanta Fed is coming out with now for first quarter. It seems a bit a bit grim. But I think what we're really looking at is like, okay, there's, going to be modest top line growth, but really that earnings growth is going to have to come through for the market to appreciate in our view. And so, yeah, obviously margin kind of across the board is going to be really important.
All right, so let's talk about that on the economic level for a second. Let's flip this and think from the government standpoint. Talk about what you're seeing in those GDP numbers and that GDP projection, because yeah, it's grim. And I understand there's a little data discrepancy inside of that chart that all of a sudden feels like don't dive into the shallow end of the pool. That's ugly. Do you think is this our future? Is this what we're doing?
I'll just give my 2 cents on that. I think it's a little bit more grim than really is what's going to be realized. And you just think about, first of all, we've seen a lot of seasonality over the last couple of years. I'd say that's consistent with what we're seeing in the underlying data. It's just this overhang of seasonality, whether it's weather or pull ahead from a consumer spending perspective. Net exports. I mean, wow. This is when you talk about, business reaction in some ways. I'm sure that a lot of companies would love to have had the foresight to be able to build up their inventories ahead of the COVID, kind of meltdown in March, April, May of 2020. So in some ways, it's like, wow, businesses are, looking ahead and really trying to execute again to protect that margin and protect the ability to and protect their input costs. So I think, there's this net export. Consumer spending obviously expected to slow modestly, but I think the other big piece is government spend, right? And do you really anticipate that that's going to come down dramatically, in this sort of first quarter? And how is all of what's happening from an austerity perspective as it relates to the size of the government, how does that translate? But I do think that, GDP now is not a great predictor of what of what you end up seeing at the end of the quarter. But I think at least from a trend perspective, it's putting that doubt in people's minds in terms of, are we going to actually deliver this trend growth this year? Or, is the first half just going to be just a little bit too challenging to do that? Or that, not our view, but I think that's out there in the market.
That's interesting, especially just you see something like that and then you can't unsee it. And there's an effect to introducing new information to a story. That's how this stuff works. Lindsey, what are you seeing in terms of GDP? Has any of the noise of the last month changed the way that you guys are thinking about economic growth for the U.S. this year?
No, I think that, again, I think Shannon described it perfectly. I'm kind of in the same camp as her, so I'm not going to rehash what she just said. But what I do think is that, GDP growth, just because we have tariffs, it doesn't need to fall off a cliff. The difference, though, is this time around, I do think organizations, companies are reacting much more quickly than what we saw even in like the pre-pandemic world. I think that's like a scar for operators right now, right? They waited to pass through prices or raise prices when inflation was taking off. And they don't want to miss that opportunity now. Again, it's probably why you're seeing the PPI start to rise too, as folks get ahead of that. That being said, tariffs don't necessarily have to be this end all of economic growth. I think the consumer, when you look at the consumer, they have been really very resilient. There is the question about what is going to happen to the job market given the government cuts that, DOGE is leading the way on. You look at if you look at the federal workforce, it's only under 2% of the total workforce. Granted, if you include state and local government members too, then it increases, but should be focused on the federal government, right? So it might not be as negative an impact. And I know there's the contractor situation that like it'll filter out into that too. So I think on that, we're kind of in a wait and see mode. I'm going to be keeping a much closer eye, as I think the rest of the market will be doing, on initial claims, because I think that's going to be a good indicator. Probably not going to get in the February jobs report. We're taping this before then. We're probably not going to see much in way of government reductions. But I think the initial jobless claims over the next several months are probably going to be a market mover, right? Depending on what they look like. The good thing about the initial jobless claims is it excludes federal workers. So you're really going to be able to see what other industries are looking like and shaping up. Are they getting nervous? Are they starting to lay off in anticipation of a significant slowdown in economic growth? We know the corporations over the last several years have become much more proactive in their layoff strategy rather than being reactive and slow down, then cut before a potential slowdown is the new way. So I do think that there's things to watch, and I do think the environment is changing, but that doesn't mean I don't think that necessarily means you change your investing strategy, I guess, at this point in time, unless you do think, like Shannon made the great point of, are we becoming more insular? Is this a whole new shift in the way we are working as a country? Because then that does impact how you should be invested.
All right, stick on the state of the consumer, because I think this nuance gets lost in this conversation a lot. And this is the great part about formats like this, because we can talk about it. The state of the consumer coming into it right now is not terrible. The state of employment right now is not terrible. The information is a lot of uncertainty into the conversation. But if you were to just snapshot characterize the state of employment in the consumer in the US as of March 6, 2025, like, how would you survey the land, Lindsey, and just thinking about the state of that consumer and where employment is?
I think we still have a resilient consumer. The savings rate went up. Of course, spending went down, which is why we've got this GDP now that's looking pretty horrific. But they still have jobs. The most important thing for the consumer is to have a job and have an income. And we've seen wage growth continue at around 4% for quite a while now, and real wage growth being positive for well over a year. So to me, that's a consumer that is still healthy. They're nervous. You look in the sentiment surveys, but so are corporations, right? So are investors are really nervous. So, but I don't know, Shannon, what do you think? I think the consumer is resilient, but it's really gonna depend on what happens in the job market.
No, I couldn't agree more. I mean, it is always the driver of, everything having to do with the consumer is not only the job they have today, but the potential for them to also find another job should they need to do so, right? And so I think the challenge here is that we continue to see this wide disparity between certain cohorts of the consumer that are doing well and those that are not doing as well. And I also think that, we did see a pretty, and I would say one of the things, like 20 years from now, I'm sure people will do great work on this in business schools, but, this increase in aggregate consumer spend by this influx of immigration into the United States, right? It wasn't just, helping to put a ceiling on wages and sap up some of that additional supply. It was creating, a bump up in consumer spending. And so I wonder, what the long-term ramifications are of that. But overall, I think what you're seeing is that consumers are reacting to the news that they hear. They're reacting to the potential for higher costs. They're fatigued. Lindsey, you made the point earlier. They're fatigued with price increases, right? And so, you're coming off of a period where people have, I think that whole post-COVID, post-pandemic surge in services spending, that's come down a little bit. People have done their trips. They've gone to Italy, like they've done their foreign things that they wanted to do. And now I think we're really at this point where it's going to be about the job market. It's going to be about overarching messaging from companies. And, are you expecting to see this huge increase in unemployment from government workers? How much of that gets picked up by the private sector? There's just a lot of questions. But I think overall, coming into this, you really couldn't ask for you couldn't ask for an environment where the consumer should remain resilient. However, with that fatigue, I just wonder how much tariffs and an increase in costs would weigh on that. So I may be becoming a little bit more cautious, just given that overhang of sentiment. But on paper, there's no reason that, consumer spending can't sort of grow at trend for 2025.
Do you feel like, stick on this, Shannon, how long does that normally take to change behavior if you don't have a pandemic or some colossal system shock event? This isn't something that happens overnight either. This is gradual, right?
No, and I mean, let's be honest. If you look at consumer confidence, I mean, it is not that predictive of actual consumer spending.
No.
So, you can survey people 1 week and then you can survey them 3 weeks later and you could get very different numbers. And so I think the translation of, am I going to continue to spend and where am I going to continue to spend? We're also at this point in the year, I talked about seasonality earlier, where people are getting their car insurance renewals and, the sticker shock from that, and whether, I don't really want to go out and go through an ice storm in Texas to go shopping, right? So I do think there is some seasonality in this. I think longer term, though, to really change the direction of consumer spending, you're right, it does take, unemployment ticking up. It takes, a real sense of concern for the consumer. And so we'd have to see broader deterioration in the labor market, broader deterioration in hiring messaging for there to be a pronounced change in consumer spend.
Lindsey, follow that through. That's a pretty big anchor, a stable workforce and a relatively stable consumer. Until you unhinge that, does that show back up in that stock market margin comment from before?
Yeah, no, I think so. I think that the consumer, inflation can only be passed, really actually occur if the consumer is willing to pay the higher prices too. If they're not willing to pay the higher prices, then it's going to come through from a margin perspective. And then corporations will have to kind of look at their expenses from a whole different angle. But I also think when it comes to the consumer, and I've done some deeper work on wage growth, and it's really been occurring at the low end, which that is still the primarily strained consumer. And it's the middle that hasn't really seen real wage growth over the last 4 or 5 years. They've seen a little bit, but not as significant as the low end. And then the very high end has seen higher wages as well. What I do think is happening, though, looking just tying some things together, and maybe this is just me theorizing, so hang on here and work with me. But there's I look at some of the labor data that comes out monthly, and if you look at part-time work versus full-time work, obviously full-time workers are going to be the vast majority of our workforce, but part-time growth has grown significantly over the last couple years, especially since after the 2022 hiring spree. We've seen a massive tick up in part-time work, and we're nearing almost mid-90s levels. We're still far from, as a percent of the workforce, we've still got about a percentage point to go, but there was a sharp uptick post-pandemic, and then it continued after 2022. And so there's part of me that if you look at those trends, you look at the change in the gig economy, and I'm not just talking Uber, I'm talking a tick up in becoming self-employed, contract work, a tick up in small business growth. I feel like there's this consumer that is being very resourceful to find other sources of income. Okay. And I know I'm kind of trying to tie the dots. Like I said, I might be theorizing a little bit here, but when you look at what the job market data has been and you look at what spending has been, we're out of the stimulus period, right? Post-pandemic. To me, how are these two tying together? The job market's been good and resilient, but has it been as strong? And wage growth has been decent for the low end, but not the middle. How has spending been so strong? And to me, I think that there's something happening in the background where the consumer is really, I don't know if they're just hustling or what, but that pickup in part-time work while full-time work is still strong is interesting to me.
Shannon,
I'll leave it there.
Yeah, I think this is a really important detail because it impacts the way we calculate stuff. This impacts the way we report on jobs, report on unemployment. Shannon, just any thoughts on that on the gig worker side of messing up the data?
This has been, I mean, it was a question when we had, these huge job openings numbers that, everyone was like, okay, yeah, JOLTS, like, that's like if the perfect person with the perfect qualifications that wanted to work for 20% less than market walked in the door, you'd absolutely hire them for that job, right? I mean, there was a lot of that in those numbers. And I don't think, I think the other thing is that relationship between part-time and full-time. That was always, part-time workers were part-time because they couldn't be full-time, right? And I think that's a great point. Like, the dynamics have changed so much. And I think that you also look at there's changes in the environment. There's changes where, in the absence of a return to as much healthcare or childcare and elder care as we had prior to the pandemic, the increased costs of that, people are making choices. So maybe they are working less, but it's because they would be paying more for those services than they were prior to the pandemic. So there's all of these things that go into the historical assumptions around the labor market that I think are a lot different now. And so I would agree. I mean, I love Lindsey's analysis. So I was definitely going with you on that. Like that makes a lot of sense, but I also think it makes a lot of what we look at on a month by month basis really difficult. And not to be an apologist for the Fed, they know that too. They're really, I mean, they're looking at this data much more deeply than they were previously and trying to figure out how they can prognosticate based on it rather than just anchoring themselves to some of these historical constructs.
I love that you took it there. So we're staying there. We're going to talk about the Fed. We're going to talk about the Fed not being dumb, which is, I think, something that's important to say. None of us, I mean, me aside, do either of you want a Fed chair job? Are they
No.
gunning for Powell's
Nope.
position?
No, thank you.
Yeah, no, thank you indeed. This is a hard job. They're in a really interesting place right now because of the focus on unemployment and the focus on inflation. Do either of you guys have a view on, Shannon, what's the Neuberger view on where the Fed is coming into this year?
Wow, coming into this year or coming into last week? Because I feel like it's
yeah, because we saw the shift. We went from what, 1 cut to 3 in the futures part. So where were you coming into this year? Where are you now?
Coming into this year, we were probably at 2 interest rate cuts. Actually, we were sort of anchored to the fact that economic growth will be maybe a little bit above trend this year because of some of the kind of the pro business sentiment I talked about earlier. But like when the market was 6 to 8, we were 3 to 4. So we have been on this path to kind of expect less from the Fed maybe than our peers. But I think what the real question is, I think the Fed would like to be accommodative. I think they would like to bring down rates. I think that their neutral rate is lower than it sits today, and they'd like to continue on that path. And so I think their biggest challenge right now would be parsing out, you get a potential uptick in inflation. You're seeing it again, right? But again, I think they're discounting, this first couple of months of the year because, we've seen that the last 2 years, and I still think there's some residual services effects there. So the Fed is really in a tough spot because, some of this unemployment that's going to show up in the numbers is going to be government unemployment. And actually, government has been additive to, non-farm payrolls over the last few years. So I think they're in a difficult place. I think they would like to cut. I think, we're still more in that, if it's 2, maybe it's, more on the 1.5 to 2 versus the 1 to 1.5 that I would have been, a week ago. But if they start to see significant deterioration in terms of consumer spending, and if they start to feel like these layoff announcements are gaining some steam and gaining some momentum, I think they are going to be more solely focused on the job market today than maybe they would have been a year ago, because I think that I think they truly believe what they say about disinflation being in place, and it's slower and it's stickier than they thought. But I do think that it is trending lower, and I think they continue to believe that.
Lindsey, same question. Where were you on the Fed coming into this year? Where are you after the last however many hours the last week has been since stuff's changed?
I was definitely on the lower side coming into this year. I was like, in 0 to 1 camp. I think what's interesting is that if you look at like the Fed Watch tool, for an example, even though the market has moved so dramatically, including interest rates, the Fed Watch tool was at two cuts, basically almost 2 cuts before the tariff news really started negatively impacting the markets. And now it's still like we're down like 6% or so on the market. And the Fed watches that we're almost at 3 cuts. So it hasn't moved significantly, which is interesting to me because if the real question and the real fear in the market is this slowing of growth, you would expect that to move higher. I mean, remember where we were at the beginning of 2023? That was a growth scare, right? We were afraid that we were going into a recession. All the headlines were there, right? 7, 8 cuts for the Fed was expected, and we had to walk that back. But we're not. So in some regards, and you look at the bond market, you look at spreads, and they've ticked up a little bit more recently, but they're still low, very low compared to even pre-pandemic levels. So the bond market to me is not sensing any sort of significant scare, it's not signaling that to me. I do think that the Fed would like to ease. I think it's interesting too that the Fed has their long-term neutral rate has moved up over the course of the last, year or two. It's not super high, but it's higher than it was, and it's lower than where we're at today. So I think that Fed Chair Powell is going to try to square that, but I think they have a very, very difficult job. Just like you started the question, nobody wants that job, right? Um, it's a very difficult job to thread the needle of between growth and inflation and what tariffs mean and how the market's going to react, how the consumer is going to react. And so at their March meeting, I kind of still expect a pause. I don't think they're very data dependent. They're not going to have the data that they need at that point in time, and that might make markets nervous. But I mean, the market's not pricing in a March cut, but I don't know. It's something to watch.
How do we reconcile, and I'm struggling with this a lot lately, the thought of tariffs being likely inflationary to the degree that they happen, and the Fed being in this mode where they might feel compelled to cut? How do you reconcile those two things, Shannon?
I think that's what Powell has been telegraphing in the last couple of press conferences. I mean, they're concerned about that, and they're concerned, especially at this time. Like, the timing is so important to think about here because they know it's already going to run a little hotter because of the seasonality. And you couple that with tariffs, and you start to think about, even if the tariffs are only on for a couple of months, right? This is not the couple of months we want. So, in terms of, setting the path for the rest of the year. So I think the Fed is very concerned about that. And if you think about the challenge that they had, and again, I'm not a Fed apologist in any way, because if you look back and their moniker transitory, and they were behind the curve, right, in terms of seeing PPI creep up, not understanding how that would transmit to CPI, not seeing how fast wages were rising and the supply demand mismatch in employment. They're loath to make a move here against something that's so clearly potentially inflationary like tariffs, right? And so I think it's more of a timing scenario right now, because I do think that if tariffs are implemented at the scope and level that would be meaningfully inflationary, they're also going to impact growth, which kind of takes a little bit of the pressure off. So I think this is more about really trying to ride the line the next couple of months. It is going to be so challenging for them. But to Lindsey's point, they're really not expected to cut until the summer. So it's just going to be a really, these next couple of meetings are going to be so tough to be able to have people feel like they still care about inflation. They don't want to see that resurgence, but also that they're very mindful of this potential growth impact.
It's going to be painful to watch these meetings.
Yeah, absolutely.
What I would just say is like, you see these tariffs are different than like demand driven inflation. They create this inflationary situation that is temporary. It's, once you cycle it, yes, prices are higher, but it's over. And if you look back, the inflation impact in 2018, 2019, because everything was negotiated down, it depends on where you land, right? But because things were negotiated down, the impact was like 1/10 of a point to 3/10 of a point on inflation, which didn't translate to a significant hit to GDP growth. I took a look back 2018 because I was like, what happened in 2018? The stock market was down 6%, right? But you know what? Earnings were up 22% and GDP growth was like 3%. So it really depends on the level and duration of the tariffs.
So let's talk about this and the meta angle from investors and what investors are looking from this here, because this is it's a confidence puzzle. And it's a paradox. And I know you guys don't know what the market's going to do. I can pretend you do, and we can hold you to it, but I won't do that to you. Shannon, what do you think if the market's focused, is there one thing that you think matters more than anything else? Or is this a case of competing priorities where priorities was never supposed to be a plural word in the first place? Like, are we just scattershot, or is there like a thing we should all be watching the closest?
I think equity investors really want to see the market broaden out. I really think they want to be able to feel a high level of conviction buying financials and healthcare and industrials and riding this industrial impulse wave. I do. I think they really want to
They're
see
sick of Mag
the
7. They're like, give
they-
Exxon a chance.
I think so. Well, not Exxon. I think energy is sort of that's a whole other story. But no, I do think that there is, and I think that what investors want to do, because I think it's indicative to them, number one, of a broadening economy, which I think, people want to really be invested in, and then two, I think that investors, as it relates to the Mag 7, I think the drumbeat of asset light to asset heavier, a significant amount of investment before monetization, valuations that feel very vulnerable. I think that drumbeat it's starting to really be more pervasive. And so I think, just from a risk mitigation standpoint, I think investors, want to take a little bit of that risk off the table, but they don't want it to be such a difficult relative trade. And so if you go into this environment where you say you're having decelerating earnings for the Mag 7, and you know that from an absolute perspective, earnings on the rest of the market are not going to be as strong as those earnings, but that delta from a relative perspective is going to start to compress, that's just the justification. So I think that's where investors are looking at. So I think that's why tariffs are particularly concerning, because, again, they want to see that earnings growth out of the rest of the market. And they understand that, during periods of uncertainty, large cap tech has become sort of the safer trade. And so, are we going to all kind of revert back to that? That's really, I think, the biggest push and pull. And I think more investors are being pulled to want to diversify rather than what we've seen over the last 2 years.
What do you think, Lindsey? Is that broadening? It's definitely not baked into the cake yet, but is this the thing people are most excited about?
I think they're excited about it, but there's a caveat that the Mag 7, that tech does have to hang in there. We can't just, if it doesn't perform well, it's going to take the whole market down with it, right? And I think, too, the interesting thing is you look at tech, you look at communication services, and from a valuation perspective, they still look very rich, even though we've had the pullbacks that we've had, right? You look at the Mag 7, though, many of them last I looked were in correction territory. Not sure where they're at right now, but their valuations have come in quite a bit. And there's a handful of them that are trading under their 10-year average PE. So I think that the sector, or some of the names within the sector, are starting to look interesting. And before this tariff situation started to really escalate, what you were seeing is that there was just this rotation into the broader market in general, which I agree with Shannon. I do think investors are really excited to get that going. We went a little variety. I guess we're tired of eating the same lunch every day. But you were seeing a rotation within technology also too. So it was like this, let's look for better valuations. Let's look for a better trade at this point in time. So you were seeing the old school tech names of the world do better. Again, ahead of the tariff fight, you were starting to see semiconductors level out. And even from an earnings perspective, the semiconductor earnings were starting to stabilize too. Even though there was still significant uncertainty from a competition perspective and from the potential tariff situation. So I think there is this desire for investors to broaden out. but they're still going to keep their weighting within you can't get out of it, right? It's such a significant component of the index.
You just can't ignore it. So we touched on it, and this isn't to comment on any particular company, but I do want to talk about sort of industries and sectors and stocks because of what you said, Shannon. If we are broadening out, are there other sectors or industries where you see their traditional quality or like quality with a growth bias that actually looks like where money would flock to now? Maybe not as the flight to safety, but where money might flock to say this is a good opportunity in 2025.
Yeah, so I think too that we talk about a lot are financials and healthcare. I probably talk more about healthcare just because I feel like I don't know, back in my very early days, I covered healthcare, and so I feel like that's my my bread and butter, if you will. Although it's probably healthcare industry's changed a lot in 20 years, so I don't know if I'd be able to drop right back in. I think the thing about financials is obviously one of our strongly held views is that M&A activity is going to pick up and that there's going to be opportunity in public and private, just from an activity perspective. There's also a lot of places to go in financials in terms of sub industries that you might be interested in investing in. There's a number of different ways you can play financials, and I feel sort of the same way on healthcare actually. The interesting thing about healthcare is it's always been viewed as a defensive sector. And then you had all of this innovation over the last couple of years with mRNA technology, with the GLP-1s and the growth of those. That's very different from what we saw with, sort of the cholesterol drug fad, and growth that really benefited companies like Pfizer back in the day. But I think what you're seeing is that you're also seeing this demographic tailwind within healthcare that not a lot of the sectors have. They just don't have, they have a lot of headwinds, if you will. So I think that the broadening out is, and I know other people are playing this differently. They're playing it in, they might be playing it in materials. They might be playing it in energy. I think energy is sort of a standalone concern at this juncture because there's just a lot of supply overhang that I think is on the horizon. And to go back a little bit to Washington, the U.S. government has made it very clear, and the Trump administration has made it very clear that they do not want to see high energy prices. And so between that and OPEC plus wanting to get more production online and a potential resolution in Ukraine, I'm maybe not quite as excited about energy, but I do think that the broadening out has, a lot of places where you can go. And then you can also go outside the U.S. And I think that's something that has done really well year to date as sort of ex-U.S. exposure in the equity market. But that's another part of your portfolio that a lot of investors, especially over the last 10 years or so, have either, been underinvested in or perhaps not invested in at all.
We are definitely talking international in a second. Lindsey, do you have any other thoughts on industries, subgroups that you think, if the money's not all chasing big tech, where else do you think people are looking that feel like a good value?
Oh, I hate to be like a broken record, but I do feel like financials, the banks have come in over the last couple weeks too. So I think that there is opportunity there. I feel like Shannon kind of hashed that out. I like healthcare. You look at healthcare, it's like the second biggest earnings growth sector for 2025. So I think there is opportunity there. I mean, granted, I always think about healthcare. I don't know how you feel, Shannon, but I feel like people just forget about healthcare. They don't want to do it until it's like you need something defensive in your portfolio. I mean, healthcare wasn't doing that great when we entered the year, but it does. It's coming with double-digit earnings growth. From a valuation perspective, it's trading at a much smaller premium. It's still at a little bit of a premium, but versus the other sectors, there's opportunity there. That's also why I like financials, because from a multiple perspective, it still looks reasonable. And there are places to go in between. I know the insurers have had a really big run this year. So maybe, but I do think there's opportunity in the banks. If you really truly do believe that the second half of this year at least is going to maybe return us to, the growth path, and we'll focus on the growth policies of the Trump administration once we get through all this tariff stuff, then I think that the financials are going to be a sector that absolutely benefit from that. Deregulation too. The other sector I would look at too is consumer discretionary, because it's been beaten down significantly. A lot of that has had to do with Amazon and Tesla's in the consumer discretionary sector. So you always have to be mindful of those two. But I also think when you listen to retail earnings this quarter, they were kind of provided like conservative guidance, but you have to remember when they reported too, they knew this tariff stuff. They had like a leg up. They knew this tariff stuff was happening. And if you reported this week, you really had a little bit of an edge to like cut your guidance a little bit to give yourself a lower bar to step over in the year ahead. But when we heard from Walmart, they talked about a consumer that was resilient, that was still spending. And again, I know this can change very quickly. If the job environment changes quickly, then this will all be different. But I do think that some of these names have been beaten down so significantly that it is worth kind of looking into, because there has been the consumer that is price sensitive has turned to Walmart and other value-oriented retailers, Amazon as well, to really do their shopping too. So I think that the consumer discretionary sector is just something to consider and keep an eye on as we get through the next several weeks or months.
On that specific point, if there's no recession, if the world doesn't end due to tariffs, or we don't go into some tailspin, something like consumer discretionary would be one of the places you would expect to be the most mispriced against that scenario, right?
Yeah, exactly. And so I think that like kind of perfectly sums it all up, and that the consumer is kind of they haven't been fully left for dead, but the people are starting to really be uncertain about the growth potential for the economy. And who's the main driver of the economy? It's the consumer. And if they lose jobs, that's exactly what's going to happen. But I also think that corporations are going to have a harder time laying off people unless growth really does substantially slow and we do get negative GDP numbers. But I think they're going to have a hard time. It's going to be a continuation of what we saw over the last year or two, where people are holding on to their employees. They're not really hiring, but they haven't been laying off significantly. I know some of the layoff data is starting to tick up, so we've got to keep an eye on it. But I think it's going to be really hard with worker shortages. That's a trend that's not going away based on the demographic situation. So I personally don't expect the layoff situation to get significantly worse outside of the government sector because of that.
All right, Lindsey, I'm giving you at least first pass on this one because I don't want to rob you of echoing Shannon in case you both agree on this. Hopefully you'll wildly disagree on this. Give me a wildly different take. You both talk to a lot of allocators, investors, people who aren't just thinking of what sector or stock or, weird meme coin of the moment to invest in. I feel like as a professional investor, I look back and say, first we wanted to kick EM out of the portfolios 10 years ago. And then it's just been several years of reducing international diversification. That IFA, those European banks, what a bunch of deadbeat losers. Everybody wants to invest in the US and they forgot about the rest of the world. And all of a sudden, the last couple of weeks, it seems to matter again. So,
Yes.
Lindsey, what do you think about that?
It does seem to matter again. International markets, whether it's emerging markets or developed markets, are both outperforming the US. And, I think a lot of portfolios have gotten concentrated in the US. You look at the last 6 years, the US the S&P 500 has been the best performing asset class by far. And so this year it has been an anomaly. I don't think you should get out of the US, but I do think it's a reminder of, again, looking at your portfolio, looking at the balance of your portfolio, because of that performance, it's probably gotten misallocated over the last several years, right? And I do think that there's opportunity, particularly when you look at Europe. I think the one thing that's coming out of the Trump administration is certainly he's lighting a fire under the Europeans to really spend on defense, has been the announcement, right? To really look at their debt situation. Germany is getting a little looser with their debt. I mean, can you imagine? So I think there's opportunity, but also I think the reason folks are piling into these different parts of the world is because exactly what we said earlier is that the valuations there look much, much more attractive versus earnings compared to what we're seeing here in the US, which has gotten very stretched because of that performance. So I still think that there's opportunity in international, but I'm not leaving the US.
Okay, so a rebalance, at least from you. You still have to have it. Shannon, what are you guys thinking? What are you saying about international diversification for equities?
Yeah, so I mean, we've been there. We've been in it, and we've been waiting for the time. So I think you just go back to some of and I don't want to echo exactly what Lindsey said, but I think a good point and one that I do think is important for people to think about is, if you're looking to increase, if you do believe that there is going to be this industrial impulse or this industrial inflection, and you would like to have more cyclical exposure in your portfolio, you can invest outside of the US because just they naturally have more cyclical exposure in those markets. And so you actually don't have to get that cute even by and just you'll get more cyclical exposure just by diversifying outside of the US. So if you're really looking for kind of the easy button on that cyclicality trade, you get it outside of the US. The other thing to think about is that if you think about what's happening, and Lindsey talked about fiscal spend in Germany, you hear all this talk about stimulus in China. Then you think about rates coming down in Europe and coming down in the UK. Wow, what did we do the last few years that created this period of relative outperformance? We had really accommodative fiscal and monetary policy. And the other thing is that outside of the US, the consumer is much more interest rate sensitive. There's much more floating rate debt in terms of housing. So there's these catalysts that are kind of coming together that compound the valuation argument. But I think more importantly, it just comes back to what do you want more of? And if you want more of cyclicality or you're overweight in technology just on the basis of 2 really strong years, you can sort of add to that cyclicality pretty easily by investing outside of the US.
What about they almost feel like the most taboo of the international exposure? Any thought on China? Dare I say, nobody can really invest in Russia anymore, but what about China? Any view on China and investing there, Shannon?
I would say that we're becoming more constructive, and our views are based on the fact that we are starting to hear more positive sentiment directly on the ground in China. So the consumer remains the huge challenge in China, right? You think about the commitment to trying to fund business investment, and a lot of what's happened with state-owned enterprises in China has really been focused on businesses, right? State-owned enterprises getting, support from the government and infrastructure boom, real estate boom. None of that's really been focused on kind of direct stimulus to the consumer. And I think what you're seeing and hearing from the Chinese government is that they're starting to acknowledge that, once again, looking to the US and what we've done, kind of more direct, if not direct, stimulus for the consumer is really what's necessary. And so I would say we're becoming a bit more constructive on China. I think that the tariff situation is kind of a known risk, unlike what we've seen with maybe other trading partners. And so incrementally more constructive, partially because the sentiment is just so negative too. I mean, at some point, it's a state controlled economy. They will make efforts, and not a small one, and they will make efforts to counteract and offset some of these the slower growth that they have been experiencing.
Very, very interesting way to frame that. Lindsey, do you have any view on any of the emerging markets in particular? Or, I still hate that we're even still calling them emerging, but, China, one of the largest economies in the world. Any feeling on their markets?
Yeah, I mean, I just think that there's, I'm not the expert on the emerging markets, but what I would say is I just think there's opportunity there from a growth perspective and from a valuation perspective too. So I think it has a place in your portfolio, and now's as good of a time as any to start to look at it and to consider it for all the reasons that Shannon said. She's much more articulate on it than I could be.
And extra credit though on that, even just the point of rebalancing. The average portfolio, if you had not rebalanced in the last few years, is a pretty dramatic overweight to the US, even after this round of volatility.
Well, and even in international technology, US is the technology component of international, and it has a heavier weight than it's ever had too. So there's that aspect.
Yeah, it makes a big difference. Let's stick on technology before we skate into these fun final closing questions I have for both of you. The technology that you're using, I'm really curious as strategists, as investment thinkers, using AI, Lindsey. You're not AI, right? You showed up authentically as yourself today. What AI tools are you using in your day job?
Well, so I do sometimes time use Perplexity to like when I'm writing and I'm like, this sentence is not that good, or like, can we smooth this out? So I will like drop in a couple sentences that I might be like writing in a research note to kind of help me. And surprisingly and impressively, it's a pretty good job. And sometimes I'll use it to do a little bit of research, but I don't know. I feel like I'm getting old and falling behind on the technology loop. I definitely need to take some AI courses or something. What are you guys using?
Interesting. Shannon, what do you got? What's in the tool?
So I think we've been thrust, or at least I've been thrust into using it because our firm is using it. And so, we have our own ecosystem. We've built a lot of we've built a lot of assistance and tools on top of our internal data. And I think it's actually helped. And to that end, we're also, we're getting trained on prompts where, we're sort of being taught how to use AI as part of our job. And so I wouldn't say it's like my first spot to go and look for something because I'm not quite there yet. But I will say that especially for the data and the research that we produce internally, it is increasingly become the first place that I look for that. So rather than going out to a SharePoint site or, reaching out to an analyst, I just go in there and I know I'll be able to find what I'm looking for. But I think it's more about like sort of training your brain, like using that mental muscle to be like, how do I get a more, and it's when you do it right, it's really much more efficient than other ways of looking things up. And I don't disagree. I mean, I think reframing, recasting, writing, I don't know. I love the voice that I write in. So it's hard for me to have that, not sound like me. But I would say, that is something that I utilize, especially if it's a long form piece and I know I've just gotten tired of it. I'll throw it in there to see how they can tweak it. And I make some of the changes. I'll put it that way.
It's just an idea generator.
Right.
I should add though, like just a little plug for Clearnomics because we are fintech. And what our technology does is it allows advisors to use the research that my team writes and the charts that we it's a database full of charts, all the different macroeconomic charts you can imagine, and some that go deeper and market charts too that you can imagine. You go in there, you can find them, and as an advisor, you can use them to create either your own notes to clients, or you could take what we've written, and we have a place where you can personalize it and edit it as much or as little as you'd like, to fit your tone of voice or anything like that. So it's a pretty cool tool. So Clearnomics, check it out. Little plug.
And it sounds like what you just described sounds very familiar to what Shannon was just describing on how like you're querying the internal data that you guys are capturing and the way you're using professionally, right? This is an efficiency boost for both of you that you're seeing.
For sure.
Oh, absolutely. Yeah.
Yeah. My experience too. Me and my dear friend Claude and Perplexity and occasionally Grok, but something's weird about Grok and I just can't get my head. Not just the name, not just the ownership structure. Standard closing questions. We're going to ask two of them. Shannon, I'm going to let you take this one first and then we'll flip it for the other way. The question is, if you could teach one lesson to the average investor, what would you want to teach them?
I would tell them to wait a week before doing anything that they think they want to do, and sit on it for a week and let it season. And then if they want to make that move in their portfolio or reallocate, then, it's probably, they probably have enough confidence or conviction in it to do that. I think I would love to say a longer time period, but I'm just being realistic about people who look at their accounts every day. So if you look at your account every day, wait a week before you make a change.
Solid advice. You don't need those extra shares of NVIDIA at 2 a.m, right?
That's right.
A week on it for normal hours, like a human. Very good. Lindsey, what about you? If you could teach the average investor one thing, what would you teach them?
I think it really would be compounding because it really is the seventh wonder of the world, right? And it kind of lines up with what Shannon said too. Like the longer you're invested, the more money your money makes and it works for you, right? So I think it's something that it should be taught in grade school.
That simple thing of what is it? The grain of rice on the chessboard where you just double it each time.
Yeah.
permanently rewired my brain to just understand that by the end of that board, you can't even see the board anymore. All right, Lindsey, you get the upper hand on this one. What is one thing you believe about investing that the majority of your peers would disagree with? Name your own peers at your peril, but go
I'm
ahead.
not going to name any peers, but I think it kind of relates also to the individual investor. And I think you and I kind of talked about this. What I would say is that most people fail into investing. So they don't read the book and they don't learn to do it the right way that all of us are here to help educate people to do. They don't hire an advisor. They just put money in the crypto coin that their neighbors are talking about. They buy the meme stock, or maybe even buy a good stock, and then they learn along the way. And usually it's through failing that you realize, oh, I have to learn how to do this the right way. But you got to get your feet wet, right? And so I think getting your feet wet and learning through failing when it comes to investing is perfectly okay.
I love
Only
that.
if you're doing it in small amounts, though. You can't just put it.
Don't fail too big, but failure is actually maybe one of the most important ways to learn investing. I love that. All right, Shannon, this is you. What's one thing you believe about investing that the majority of your peers would disagree with?
So I will preface this as saying that I went to school and I got degrees in history and economics. So, but I believe that we spend far too much time as historians and not nearly enough time as futurists, as investors. So I think anchoring to these periods, having experienced them, there are so many things that have happened in history that were a point in time that if you put the actual context around, you realize that they may be not at all applicable to what you're experiencing today. And so I think in order to actually be a successful investor, you have to think about what might be instead of what's happened in the past.
That's fantastic. Without saying this time is different too many times or torturing yourself with whatever way that's going.
Well, it may or may not be, but more importantly, you're not investing for something that's happening today. You're investing for what's happening in the future. And I think we just spend a lot of time trying to anchor ourselves to something that we've experienced or that somebody else has experienced in a book, and really not thinking about, what does the world look like in 5, 10, 15 years? And being willing to kind of go out on that limb with people that are already there.
Brilliant. Lindsey, if the people want to learn more about you or economics, or Clearnomics, they can learn more about economics too. They want to learn more about Clearnomics, follow your work. Where should they find you on the internet?
Clearnomics.com, or I put stuff on LinkedIn all the time as well.
Fantastic. Shannon, same question. They want to follow more of your work. Where should they find you?
Either at nb.com or nbprivatewealth.com. And I too use LinkedIn on a regular basis.
All right. Find both of these people on LinkedIn. You're watching Excess Returns. Like, subscribe, comment, all the things. Thank you both for joining us so much.
Thank you.
Thank you.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on YouTube or your favorite podcast platform, or leave a review or a comment. We appreciate it.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the participants or their clients.